Good morning, ladies and gentlemen, and welcome to the VIANET Group PLC interim results presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would like to submit the following poll, which will just appear on your screens now. And I would now like to hand you over to the team from VIANET Group PLC. James, Mark, Craig, good morning, guys.
Yeah, good morning. Thank you, Jake. I'll kick straight into the results. A good set of results, despite the economic backdrop. I think what we've done is demonstrate the resilience of our core hospitality division, and in particular the leased and tenanted sector. And we're gathering real momentum in vending and demonstrating progress in new verticals. And this is all fueling our ambitious growth plans. For those of you who are new to VIANET, we'll have a quick overview of what we do. Basically, we transform business performance. We install hardware that allows us to capture data, and then that is processed with our management software to create dashboards and alerts that allow our customers to run more effective businesses to improve their productivity and performance. Two divisions. There's the unattended retail division. That's where we provide a comprehensive end-to-end vending management system that basically allows customers to really drive more efficient operations. And I'll come back to that in a bit more detail. And our second division is Beverage Metrics, our hospitality division, where we have the market-leading comprehensive beverage and bar management system. How do we make our money? Well, we install the hardware and we get paid a reasonable margin on our hardware. And then we enter into long-term contracts for weekly and monthly fees to cover service packs, licenses, and data management. Majority of our customers are on 5-year contracts, with very few less than 3 years. We turn over to the sort of financials. As I said, a good set of results, really encouraging given the inflationary backdrop and I guess the 3G switch off and this drag created by that as customers made their minds up as to how they're going to address the requirement to upgrade their devices from 3G to 4G, and also the fact that we've been migrating customers to our smart vending management platform. Revenue up to marginally to 7.19 million. Flat generally because we've had a high number of rental units going in during the period versus CapEx, which we traditionally have. But what that has done, it's improved our gross margins. So hence the bottom line result being positive. Recurring revenue remains very strong. 87% of turnover, and the rental margins as a proportion of the mix has helped us drive gross margins up to 69% from 64%. So that's been positive. Basically, very strong recurring revenues, strong gross margins, and very good operational cash generation. And that's allowed us to return to pay a dividend for the full year 23, and positions us well to pay a dividend in the current year. But Mark will come back to that in a bit more detail. But I'll turn over and touch on our growth ambitions. We've got a fairly ambitious top-line growth agenda, and we've done significant groundwork. In fact, all through from the start of the pandemic all the way through and ongoing, we've been doing groundwork that's created the foundations for our ambitious growth aspirations. I guess if we look at key elements of our sort of ambitions, is one, retain and attract people. It's a challenging employment market. And what we want to do is actually ensure that we are seen as the trusted advisors by our customers. That means we have to have great people. That means we have to do all the right things to sort of attract them and engage them and keep them in our business. And we've been doing that very successfully. Touch on the commercial opportunity that goes with our ESG agenda. It's not just about saving costs ourselves and reducing our own carbon footprint, but in both our hospitality division and in our vending division, we help customers reduce their carbon footprint, whether it's energy saving in pubs and bars, or whether it's down to dynamic route planning that reduces the carbon footprint of each Mars bar that's being delivered to a vending machine. That gives us a raison d'etre to drive forward with customers. Our ambition over the next couple of years is to get to 100,000 vending connections, currently at 56,000 at the end of September, another 44,000 to go. And we can do that with our existing customers and some of the progress we've been making in new verticals. Then growth ambitions in hospitality, to go from 10,000 to 14,000 hospitality sites, and we'll be doing that on the back of our beverage metrics integrated with our own solution, the energy saving devices that we're working on, and the work that we've been doing with brand owners to get more flow meters on the brands to demonstrate what's happening out in the marketplace for them. And we're making inroads into the managed sector as well. I think overall, all the proposition and the route to market, they're both in place for both divisions, and we have the ability to expand in the USA and also drive new verticals. So the key elements of a strong investment case are sort of coming together as we turn the page onto page 5. The investment case is gathering momentum. We've got strong products, significant markets, and the growth levers are working in our favor, and we consider ourselves to be undervalued as well. If we look at the markets in the UK, there's something like 300,000 vending machines, and that's only going to grow as there's more unattended retail and micro markets out there in the marketplace. In the EU, there's 3 million vending machines, and worldwide there's about 15 million. We look at hospitality in the UK here, we've probably got an addressable market of about 50,000 pubs and bars. Probably 11,000 of those are going to be in the leased and tenanted sector, and probably another 12,000 in managed, and the balance in independents. And in the US, that's a massive potential market for us, where we're just starting to make some inroads. 382,000 hospital licensed on-premise outlets with alcohol beverages. If we look at the growth drivers, we're leveraging those contactless payments on the growth. You throw in the work that we're doing on QR payments as well, and we're well positioned to take advantage of the growth in contactless. The ongoing growth in unattended retail as the cost of labor increases. More and more facilities are moving to 24/7 vending availability versus having canteens and kitchens open all hours. And that's only going to grow as technology becomes more sophisticated in terms of allowing hot meals. And the whole remote asset management piece, if we can actually access data remotely and make service and maintenance operations and restocking operations more efficient, then that's going to reduce carbon footprints and that ensure higher uptime as well. So they're all positive. And the ongoing demand for data is only going to grow. And whilst we're not doing a lot on AI at this moment in time, the data lake that we sit on has value. If you look at the business itself, strong recurring revenue, good earnings visibility from our 5-year contracts and the renewals that we've had, and the ability to expand our margins as we layer on additional products and services. strong cash flow generation as well. So in a very good position. Basically, we tick lots of boxes in terms of markets, the products we have, the customers and the relationships and engagement we have with our customers, and the partners that we've sort of chosen in both the hospitality and vending arena. And lastly, our people. Now, basically, they do the right thing by instinct, and we are, over the last 4 years, we've really set our stall out to become the trusted advisor for our customers, and that's been paying massive dividends. If we look over the page and see how are we doing? Well, we're on track. I guess the investment that we made all the way through the pandemic and ongoing, that's into the investment in our product, in our infrastructure, our people, our customers, and our suppliers, has created a lot of goodwill, and that's paying dividends for us as we're become a preferred supplier for many of our customers. We've got a healthy pipeline that creates a good foundation to drive the business forward from. If you look at beverage metrics, we dominate the leased and tenanted sector in the UK. In fact, we don't really have competition in the UK, which is great. But it's important that we don't rest on our laurels, and we're taking new products and services to the leased and tenanted sector and becoming even more relevant to them. And in parallel, we have products and services that are now becoming more relevant in the managed sector, and we've been making good progress there, where we become a really good option to actually, I guess, there's a limit to what managed operators can do now to drive growth at outlet level, primarily because there's the pricing elasticity is being stretched to its limit, whereas for the cost of if you have one extra pint going through the till, that pays for our system, and we can do that so purely by reducing shrinkage at the till. Data demand and demand for contactless continues to grow, both in our core business and in new verticals. I guess what we've been doing is that we've been demonstrating that the key elements are in place and provide us with a real growth platform. We look over the page onto page 7. This is what drives, our vending operators to have connectivity, but also contactless payment solutions in their vending machines. A vending machine is a small supermarket. It's just that it's remote and it's unmanned. So real-time data is essential to provide the dashboards, the alerts, and the dynamic planning that's required to feed into their ERP systems so they can run more productive operations. I'm not going to go into each of these benefits, but I guess those benefits in the middle sum it all up as to why our customers invest in connectivity and contactless payment. It's about increasing machine part productivity and uptime. It's about having operational transparency that allows you to actually drive real-time improvements, and it's about ensuring maximum availability of stock, and also that maximum availability goes hand in hand with reducing the amount of stock you have in the warehouse, so you're actually reducing your working capital requirements. And then if you take some of our big coffee customers, they're also interested in quality. They want to know that the machines are being cleaned, the milk is being cleaned. They want to understand that it's their coffee that's going through the machine and not some bean roaster down the road. So everything kind of works in our favor. And then we look at the complexity of the payment system, our ability to interface with accounts package providers, whether that's Access, Xero, QuickBooks, you name it. That integration is important, and we have the ability to do that. And it's pretty complex because in the vending arena, you have revenue share agreements on some machines, and you have some customers have rebates. So you want to stay on top of that. And the insights and analytics piece, it's really about understanding what sells where, when, and to who. And we can do that working with our partners. So the bottom line is, We help them reduce their costs and their carbon footprint by making them more efficient when it comes to restocking, service, and maintenance, and they get compelling returns. We've several examples in some of the larger customers of over 20% operational savings from installing our contactless and connectivity, and they're also seeing sales uplift from 100% uptime or 100% availability. And we work with the winners, and the winners are the winners who are embracing digital and embracing technology. So we're in pretty good position in that respect. How does that translate into our performance? I talked about the ongoing investment that we've been making over the last 3-4 years into our product, people, and customer experience, and being the trusted advisors is paying us dividends. We've got leading hardware, we've got leading customer support, we've got great management software. Our transaction rates are probably the most competitive in the sector, and our pricing is right. We've got clear blue ocean between ourselves and the competition, and we're starting to make inroads on the back of it. One example would be around about the network operators 3G switch off that's been taking place over the last 12 months and will continue to take place over the next 12 months through to the end of 24. I think it's probably about 7 or 8 months ago, we provided a comprehensive 3G switch off guide that explained everything, 16 pages, explaining to customers exactly what was happening and what our response was to it. And I guess that we were probably about 6 months ahead of the competition on that, which really sort of underlined our position as a trusted advisor. And that fed into our retain and gain strategy. But the 3G switch off and the requirement for customers to upgrade devices from 3G to 4G could be seen as a risk or an opportunity. We decided we would make it and drive it as an opportunity, by securing our existing customers on extended 5-year contracts for the 4G installations, but also going out there with very compelling offers for competition, customers who are with the competition, and we've been picking up new business on the back of that. I guess the first sort of 6-8 months of this year, customers have been taking time to understand the need to change or upgrade from 3G to 4G, and understanding the implications, pulling together their plans. And it's only really been in the last couple of months where we've really seen an acceleration of a really pressing urgency to upgrade from 3G to 4G. And that's why we're feeling good about the headwinds in the first half are real tailwinds in the second half. So we're really pleased about that. The other thing that we've done in the last several months is actually make real inroads into buying groups. Historically, we didn't have many customers in the buying groups, but we've really made inroads into the buying groups in the last several months, and that's going to pay dividends running through into the new financial year as well. The estate is growing to 56,000 devices, and that basically reinforces our recurring revenues. Our adjusted operating profit up to 1.05 million, up around 30% from 810,000. So in good shape. We've also made strategic move or gain in terms of a contract win within the forecourt arena. And what's working in our favor here is that for the past 18 to 24 months, we'll be doing groundwork. We have key relationships. Craig, our Chief Operations Officer, his background was forecourts with Morrison's, and set his own business up. He's got lots of connections in the sector, and we've been working with those relationships hand in hand with SureSight, who allowed us to go to market with some fantastic transaction rates. And we've been, we're secured an 800 device order with a leading operator, and that's a 6-month rollout that started this month. So that's a great win for us. The SureSight transaction rates, that really makes us very competitive, and the competition struggle to deal with that. And I guess the other thing that's worked in our favor is that our proactive approach to 3G applies within the forecourt sector as well, because there's been I guess there's the early adopters of connectivity and contactless in the forecourt sector. That's forecourt balloting. They've been caught out. Well, I guess they have a need to upgrade from 3G to 4G, and there's a level of dissatisfaction with the existing providers. So the other big positive about SureSight, they are in effect another arm of our sales force in the forecourt sector. So that's great news for us. It gives us a lot more coverage. Lots of live discussions going on. It's a significant opportunity here in the UK and in Europe. And I guess this by necessity, this slide is anonymized for competitive reasons, because we're making real inroads, and we don't want to give our hands away. Moving on to hospitality. No, basically, we give our customers significant benefits and compelling returns on investment, and that's by reducing waste, improving quality, improving sales, and driving up productivity, and by ensuring that our customers can give their drinkers an enhanced customer experience, I guess. It's part and parcel of the factors that you see in these boxes here. They really are help create a beneficial circle, rather than the opposite is also true. If you're not doing these things, you end up in a vicious circle, and you end up with a business that's in decline rather than being transformed. The other great thing about the hospitality business and what we take to market is that we can actually give a return for the customers from day one, simply by hooking up our real-time core data with the point of sale data to do shift loss analysis, and that will drive profitability from day one. If we look at that, the bottom line is that the integration, having integrated the beverage metrics acquisition with our smart zones business, that's enhanced our offering by giving us real-time inventory and point of sale reconciliation that really makes us relevant to the managed sector as well. So we're in very good shape in that respect. The other thing as well is that the bottom line is that you have one extra pint going through your till a day, that pays for our system. In terms of looking at the results for the period, core leased and tenanted has been robust, and we're confident that we can sustain the performance in leased and tenanted and probably get it back into growth, because leased and tenanted has been performing better than managed in other areas of the pub market during the cost of living crisis that we're going through. We're making inroads in the managed arena, as I said, because they have limited options. Pricing elasticity is getting closer to breaking point, and if we can give them a day one return from selling one extra pint a day, then that's positive. The recent we've in the last 2 weeks we've completed a number of installations with an energy management system for beer cooling systems in cellars that can reduce consumption by round about 50%, 40-50%, and that in itself pays for itself, and an average pub probably benefits to the tune of £1,500 a year. And I guess lastly, that full beverage metrics integration piece, that's worked really well for us. because we can give the hub unit manager or the regional manager everything they need in seconds every day with a dashboard. I don't want to dwell too long on the States, but I'll touch on it. The bottom line is that we have the most comprehensive, scalable, proven, drinks management solution following the integration of beverage metrics. In the US, for instance, we don't have any real competition in the UK, but in the US, for instance, there's 5 players that do draft beer monitoring. There's probably 50 that provide inventory, and that's a lot of those guys are point of sale providers, but there's none that provide the combined solution that we provide. And as I said, that instant configurable dashboard that gives the unit manager everything they need in 30 seconds, and we capture all the financial data. So whether that's the pour cost, whether it's the point of sale loss, or whether it's margin analysis. Margin analysis, we can do at drink level, brand level, tap level, site level, or region level. And that's something that's very difficult for operators to get to otherwise. The other thing I'll pick up on here is FinTech, our partner in the USA. We've been doing full integration with them. When I say integration, we will capture an order. That order will be processed back through our partner's drinks management system, because our partner, they do payment processing for in excess of 30% of licensed on-premise venues in the USA, which is a significant opportunity for us to actually integrate with them to actually cover an end-to-end beverage management ecosystem that includes our inventory system. I won't spend too much on the addressable market in the US. 382,000 licensed premises across 4 key segments. In the restaurant sector, big players are Applebee's with almost 1,800 units, Brinker / Chili's with 1,200, and Bloomin' Brands with over 1,000. And these are all guys that we're talking to and in discussion with as we speak. And then you look at hotels, almost 1,400 married hotels with bars. So effectively, our relationship with our partner in the USA gives us access to these guys, but also to individual and smaller chains that allows us to drive our sales operation. In terms of where we are, we're tracking to establish a successful US business with the objective of being monthly break even in full year 25. The proposition is pretty compelling. Return on investment is 3 to 6 months, and as it drives performance and productivity, and it's pretty much self-funding. 1 pint a day going through the till pays for the system. And we've got a number of, I touched on the partner and the automatic ordering, invoicing, and receipt of goods. That gives us a fully integrated end-to-end for drinks management. And that's really important for operators because the amount of time that's taken at the moment for an operator to place an order, we effectively provide them with a suggested order. They press to accept the order. That goes to our partner in the US, and then that gets farmed out to the various suppliers, and then we get the e-invoices back, and then we close the loop when the goods are received. And that when the goods are received, that's when we do the full inventory reconciliation, and it becomes a beneficial ecosystem. So very positive. Just touch on a couple. I'm not going to go through every sort of prospect here, but customer A, that's an existing customer that is rolling out a franchise, and we are on the franchise technology stack, and that's going to deliver us growth through the second half into full year 25. And then just looking at the payback that the ROIs that our customers are getting, it should be a no-brainer going forward. It's just a case of, I guess, that point of sale shift loss report delivers an excellent return on investment in its own right, and the options are narrowing for managed operators in any case. So we are a quick win, address the point of sale, address the loss, and improve the productivity. I'll hand you over to Mark now, who will take you through the financials.
Morning, everyone. Just starting on the headline P&L performance, you can see there that turnover is marginally up year on year, held back by what Jim referred to regarding the 3G impact and customers having to understand the impact of that. So that held us back, but that should improve in the second half. It'll be a driver for us. Gross margins are up, due largely to the incremental recurring revenue growth we have seen and a reduced cost of operations that we've delivered in the year. So there's an improving gross margin scenario there. EBITDA, our operating profit, is up 7% to 1.297 million, and that is net of post-acquisition costs of operation for BMI around about 0.2 million. If that was done on a like-for-like basis, then the growth would have been 23% year on year. The pre-exceptional PBT of 159 grand there, that's back in the black, which is pleasing to see. And again, that is net of the 200 grand BMI costs, so it would have been 359 grand. The exceptional costs that we did incur in the period largely relate to the acquisition of BMI, all the advisor costs and the legal costs in delivering that. So overall, we delivered a loss before tax of 171 grand. Again, net of the BMI 200 grand. Like for like, it would have been a small profit. And that translates into the EPS, 0.58 there on the negative side, but without the BMI and the like for like position, it would have been a small positive 0.02 EPS. And EBITDA on a like for like basis year on year would have been 3.7% growth. If we move on to the divisional performance, Smart Zones, turnover was not a million miles away from the prior year. We had 105 new systems in the period, but the net estate did reduce by 153 sites. But that is a slowing of the decline in the estate size. In the previous year, we had 356 sites lost to us. H2 will see new systems being delivered, so we do expect the estate to remain in and around the current 9,700 that we have today, and James touched on earlier. Gross margin improved from a healthy recurring revenue base, but also a reduced cost of operation. We don't carry quite as many engineers, and we don't use the intelligent flow meter as much with the development in flow meter technology that we've had in the period. So there's a reduced cost to serve our customers. Year on year, overall, the profit to be slightly behind last year, but that is net of the 200 grand BMI costs. So like for like in the UK, the division returned a 4% uplift in profit growth. The recurring revenue remains strong as ever. The division remains a resilient performer and cash generator. In terms of Smart Machines, you can see the turnover is ahead year on year. Yes, held back by the 3G to 4G network impact as we've discussed, but H2 will be an accelerator for that. We had 37 new contracts. We had 5,264 new connected devices, and all that contributes to the estate growth of around 6%, being just shy of 56,000 connected devices that Jim referred to earlier. That all underpins the recurring revenue growth you can see there to 77% and the improved gross margin that we've got. And we have a slightly lower cost to serve in that division as well. So overall, we're seeing a continued growth in operating profit by around 29%. To 1.049 million a year, despite the 3 to 4G lag. So we're very pleased with the performance of the division, and that is set to continue. In terms of the cash flow, the business continues to be a reliable cash generator. The pre-working capital profit to cash conversion was 97%, or 104% of EBITDA. The post-working capital conversion of profit to cash on an EBITDA basis was 105%, which is a significant step forward from last year's position of 0.67 million. The working capital in the period was flat and more normalised. We said that the stock investment that we were making in the prior periods would abate, and it has done. So you've got a broadly flat movement in working capital there, which is what we expected to see. So we have decent cash generation operationally post working capital of 1.269 million there. We had a tax receipt of 923 grand. That pertains to tax losses we surrendered in March, and we received that money in May. So overall, we had an operating cash generation position of just shy of 2.2 million, which is obviously very healthy. We've invested in new tangible assets around rental equipment and R&D. The R&D is tracking about 0.3 million less than the year before, so that's again is improving. And we obviously refinanced our bank facilities with HSBC, and that's reduced the onerous repayment profile that we used to have, and I'll come on to that when we get into the balance sheet. So that's again improved the cash position of the business. So in summary, the combination of the results we've delivered, the cash generative nature of them, the tax receipt we've done, and the refinance of the bank facilities gives you a very healthy cash inflow position that is set to be maintained. If we move on to the balance sheet has been strengthened with the more flexible bank facilities we have now with HSBC. We have a less onerous payment profile which support the growth ambitions of the business. In facilities, we now have a 2 million committed, 3-year committed RCF at 2.62% above base, a 0.84 million mortgage for 15 years at 2.42% above base, and 0.6 million term loan for 4 years at 2.52% above base, all very competitive variable rates of interest and at least 1% lower than our previous provider. What that does for us is it reduces the amount we're repaying in bank debt by about 350 to 400 grand a year, which would rather invest that in the business. And we used to be spending around 800 grand a year in bank repayments. So it's strengthened the balance sheet, reduced the cash outflow on debt repayments, and it's a very healthy position to build from. Our net debt has reduced significantly to 2.09 million from 3.56 million last year. So it's a strong position to go forward with and realise our growth plans, as Jim has touched on. Now hand back to Jim.
Thank you, Mark. Well, I hope we've demonstrated that we are in a position to drive growth in earnings. The markets and trends are positive for us, and that they're very favourable levers as we sort of drive forward. The cost of living crisis and inflationary backdrop, that actually means our solutions are increasingly relevant because people need to run more efficient businesses and be more productive, do more with less, and that's what we allow people to do. And with it, we give a very compelling return on investment. If we look at the unattended retail division, we've secured long-term renewals with our existing customers, and we've making inroads into buying groups, driving new business as well. And that's all helped by working with partners. Take SureSight and the really attractive transaction rates that enable us to go to market with. And then you've got Vendikin, who give us QR technology that we can actually look for the next phase of development in the unattended retail sector. And if we sort of look at the hospitality division, well, leased and tenanted is resilient. Over the coming years, we'll probably see more managed operations return to leased and tenanted. For some years, there was a move from leased and tenanted into managed, but we'll probably see it reverse. Why is that? Because the cost of employing people is only going to increase. The red tape is only going to increase, and it makes it. I think you've got somewhere outside London, got to be making 6,000, 7,000 a week before you can justify an outlet being a managed outlet. So that's going to help drive our existing leased and tenanted. But we've also got a product that's now relevant for managed in a very, very real way. So we're expecting to see growth in both the UK managed and in the USA. And then the demand for data and our ability to commercialize our existing platforms and technical capability has allowed us to make that strategic move into forecourt valeting. and providing connectivity and contactless payment there. And we see that as being a big win for us over the next year, 2 years, and we're making good inroads. And energy saving in pubs and bars. If we can with an energy saving management tool that can allow your average pub to enhance the bottom line by £1,500 a year, then it's worthwhile having, and gives a really good payback. So in a very good position. And the quality of our recurring income is only going to improve, and we're going to be creating a lot of cash and be in a position to actually pay an improved dividend going forward. And the bottom line is it gets back to people and working with the right partners and ensuring that we remain trusted advisors and partners of choice with our customers. And that's key. It's fundamental to everything we've achieved over the last 3 years. And it's going to be a focus going forward as well. So that ends sort of the presentation. We move on to questions now. And we have some pre-submit questions here, which I'll read out. Number 1, my question relates to the expansion opportunity in the US. In the UK, it tends to be that the majority of pubs are owned by breweries and chains. Well, actually, in the UK, I think there's something like 11,000 pubs in leased and tenanted, and probably in the region of 12,000 in the managed arena, and the balance are independents. In the US, basically what we have here is we've got a total market of 382,000 on-premise licensed venues. 64,000 of those are in chains of more than 10 outlets, and if you look just at pubs, bars, and licensed restaurants, there's something like 250,000 in less than 10 sites. How does that impact our route to market? Well, we get access to access to decision makers in the big chains is important because that's the level at which they'll make decisions to invest in our equipment and our services, and utilizing existing relationships and partnerships. We're getting increasing access to those chains in the US, in addition to the ones that we've been working with for some time. And working with one of our partners in particular, that gives us access to the independents and smaller operators, and that's something that not many people can get access to. So it's quite unique. Question 2. Can I ask about how Stella Panu's non-exec appointment came about, please? Well, I guess number 1, Chris Williams, our chair of audit, was retiring after a good period of time with us. So we needed to find someone who could chair our audit. And we're also looking for someone with city and financial experience. And it just so happened that we've known Stella a long time. She was one of our first investors when we IPO'd in 2006. And over the years, she's been one of our most challenging investors, perfectly prepared to give us a hard time. And that's as a leader in this business. I don't want yes people in my business. I want people that tell me how it is. And we're fortunate in that Stella became available, and I basically had the conversation with her, and she accepted the role. So we're very pleased about that, and it's worked out. And it's working out really well and real value added. Question 3. In smart machines, you talk about a sizable addressable market of $37 billion, and you have growth connection, and you've grown connections by 6% to 56,000 connections. Over the next 2 years, looking at your share of market, what is the realistic number of new connections you are targeting? Well, we're targeting to be at 100,000 new connections within the next 2 years, which would be another 44,000 new connections. And we can get there through a combination of existing customers where there's still significant scope for growing the footprint and new customers. And that's before we look at the opportunity within forecourts. Question 4, how big is the unattended forecourt market? What specific other new verticals are you targeting, and how far advanced are they? Well, the UK forecourt market numbers about 8,300. Half of those have some form of valeting, whether that's air systems, vacs, or jet wash or car washes. If you look at that 8,300, a third, there's probably somewhere in the region of about 2,000 of those still operate in cash only. So that's a big, there are two opportunities here. Conversion of cash only to our new 4G systems. And the other opportunity is to replace early adopters 3G devices with our 4G units. And that's what we focused on. So a significant opportunity. And in terms of new verticals, we're in discussions and have proof of concepts in a number, everything from standalone toilet modules through to EV charging, you name it. It's endless. Our platform is capable of actually and technology is capable of addressing a number of remote asset management opportunities. Question 5, given that you sold an additional 105 new smart draft systems, why is your turnover lower than H123? Well, turnover was marginally lower because the net hub closures was 153 in the first half. I expect to see that turn around to a net gain in the second half. So overall in the year, we'll probably end up with being hopefully somewhere that's pretty close to flat in terms of the number of hubs that we have in our estate during the year. Point 6, given you previously have had exposure to the US market through AMC, can you explain in greater detail why you're confident that the acquisition of BMI will now enable you to unlock the market? Is AMC still a client? How many active discussions are underway in the US, and what number of system sales are you targeting in the next 12 months? I'll take those one at a time. The integration of beverage metrics with the lead-in draft beer solution in worldwide creates a full drinks management solution, and operators can get a return on investment purely from the point of sale shift loss data. Day one, the system is installed. We see an uplift in what's going through the point of sale. Now, basically, people know that there's a system in there, so they start complying, behaving. So that in itself drives the return on investment, and that's before you start to look at the productivity gains that are available. You think about it. If you pour the perfect pint, you're not wasting time topping it up. You're not wasting time with foam. You're not wasting time. You're not having a customer standing behind the bar waiting on that pint. So he gets his pint earlier, he starts drinking earlier, and you start serving the next one. You have a much more productive operation before you look at the waste pouring. In terms of the AMC was a bit of a setback for us because AMC, as with all theatres during COVID, they found it very, very tough during the pandemic, and they barely survived, and they couldn't afford to pay us, so we ceased service, and we basically started building up our momentum from scratch. We're at 120 sites in the US as we speak, and our goal by the end of full year 2025. That's in the next 15 months, we're looking to be break even in the States. We figure that takes 300 draft sites where we've been doing draft beer monitoring, and 250 where we have the 3D fast scanning inventory solution being sold. So that was the pre-submit. I'm just looking now to see if I can see the live Can you please comment on the composition of your customer base and how it has evolved over the last 12 months? How do you ensure that sufficient levels of customer satisfaction and retention? I guess that's two questions there. How do we ensure the customer satisfaction? Well, unlike if we take the vending, unattended retail market, unlike the majority of our competition, we continue to invest in our customer experience. We have our own field engineering, and we continue to invest in our products and solutions and people. And that will drive that ongoing engagement and keep retain us as the customer, as the trusted advisor who's delivering that experience. The other thing, there's a compelling return on investment. There's real stickiness. If you get in there and you actually look after your customer, they're not going to want to change because the cost of change is substantial. So that's why 3G to 4G has been so important for us, a cracking opportunity to really take advantage of a need to change and couple that with some dissatisfaction with existing providers, and that's really opened some doors for us. In terms of the customer composition, I don't have it at hand, but what we have seen is we've seen a growth of the vending operators in our top 10 customers. People like Jacob Dow Egberts and Lavazza breaking into the top, but that's something that we will publish on our website in terms of more detail on that. Next question. Earlier in the presentation, you referenced you do not see much competition in the UK. Why do you think that is, and what steps do you take to remain competitive in the market? Well, there is competition in the unattended retail space. There are global players that we compete with, and we compete very well with for the reasons I've just covered. But if we look at the hospitality market, we don't have any competition in the hospitality market. But we don't rest on laurels. We don't abuse that dominance that we have. The bottom line is that we focus on giving our customers a return on investment and giving them a great service. And by doing that, that means they'll stick with us. And that makes it. If anyone, over the years there've been a number of players who've tried to come to the UK and enter the market, and they've all failed, primarily because who would want to risk having egg on their face by moving from someone who's a trusted advisor delivering a service and then take the risk of basically failure. That's all the questions. Is there another one coming? Oh, there's another question just come in. Maureen, thank you for your presentation. Can you comment on the value of upsell, i.e. the expansion rate and customer churn, please? Were you able to increase prices in 2023? Many thanks, George. The bottom line is that all our contracts have RPI built into them. But as you can imagine, when RPI was up 11-13%, we didn't abuse our position. We capped it, I think, at 6% at one stage. So and I guess the cap is now down beneath that that's pretty much where we are. In terms of upsell, let's take hospitality in terms of an upsell. 9,700 pubs and bars here in the UK. We probably have the ability to sell energy management solutions into each of those pubs and bars, because there's a good upside in terms of an extra £1,000–1,500 going to the bottom line in an average pub could make a difference. So that's one example of upsell, and I guess there's other opportunities as well, because what we haven't done is we haven't sold in our inventory solution in the UK yet. So there's further upsell availability, and then there's with our access to what we have in pubs and bars, there's opportunity for us to move to add retail compliance to what we do. It's fairly easy bolt-on. And I think that's the questions now finalised. So.
Absolutely. James, Mark, Craig, thank you very much indeed for addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish those responses on the platform. But James, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Well, I guess I just hope that we've demonstrated that we're in a position to really drive growth in earnings. Whether it's layering within our core leased and tenanted, whether it's our successful entry into the managed arena in the UK, whether it's the progress we're making in the States and are working with our partners there, the proactive approach to the 3G switch off, how we've made progress there, and the strategic entry into forecourts. Some really big positive things that over the next 6, 12, 18 months are really going to shift our top line and bottom line, and that's important. And I think the bottom line is that if you look at management have 20% of the stock in the business, and we're invested in this business, and we want to see have the ability to pay a decent dividend. End of. So really appreciate your time, and we're always available if anyone has questions down the road. Thank you.
Perfect, James. Thank you for that, and thank you once again for updating investors this morning as well. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of VIANET Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.
Thank you.
Thank you.